What C of the required says, discuss the tax consequences of the 84,000 rands interest income received by the Ringman Family Trust. Clearly indicate which taxpayer should be taxed, and your answer should include supporting calculations and references to the legislation where necessary. So this is a discussion question. Now, before we start looking at the detail, let's just go and look at that 84,000 rands. So the 84,000 rands they talk about is this 84,000 rands over here. Now I'm going to remind you what happens here. 37,800 of that goes to Alex Ringman, who is a non-resident, and 46,200 is retained in the trust. Then if we go and look at the information, Gareth, who is the grandfather of Alex, donated this investment. It earns interest evenly throughout the year. And then he passed away on the 15th of November 2018. Now those are all important things. Now, before I continue, let's just actually take a look here. This is 15 marks, guys. It's a lot of marks. See also they ask you for the tax consequences. They don't ask you for income tax consequences. So tax consequences means all the tax consequences. Now, you've got a solution with all the detail. I'm going to talk about it to just help you work through that solution. So if they ask all the tax consequences, it means you have to discuss VAT. It means you have to discuss withholding tax on interest. Remember, this is only for non-residents. And we know we have to discuss that because Alex is a non-resident. And you have to discuss income tax. Now, when you're looking at income tax, it's useful to think about it in terms of the tax framework. Now, if I just take you back, when you looked at part B of the question, do you remember this tax framework we spoke of? Gross income, less exempt income, there's deductions, plus allowances, and so forth. That gives you a good structure. You have to discuss the gross income, exempt income, and any deductions. So you would have to discuss gross income, exempt income, and deductions. But there's no deductions here because there's no expenses incurred in respect of it. Now let's quickly just talk about it. So the VAT is an easy mark. It's a financial service. So it's exempt. The trust is also not a VAT lien or anything like that, but it's a financial service. The withholding tax. Now remember, it only applies to non-residents. Now, as we did during the reading time, remember, the exemptions, there are a couple of exemptions, and it is if the SA government pays it, if a South African bank pays it, or if it's in respect of a listed debt. There's also ones which says if the non-resident was in South Africa for more than 183 days in the preceding 12 months. But in this case, in this question, they specifically tell us that everything received from that is in respect of a listed debt. Where is that? A listed debt instrument is solely focused on listed debt instruments. Okay, so that would mean that there's thus no withholding taxes as well. So these are all things that you would discuss. Then under income tax, gross income. You have to consider if it complies with the gross income definition. Now, for residents, it's their worldwide income. And this is from a South African source, so there's no issue. For non-residents, it must be from a South African source. But before we look at it, let's look at the gross income definition, which says it's the total amount received by or accrued to a person during the year of assessment, which is not capital in nature. Is the interest capital in nature? No, it's not. If you think of the tree and versus the fruit argument, which is discussed in the Visser case, this is the fruit produced by the deposit or by the money market account, the investment. So it's gross income. Interest is always gross income. So it is gross income. So you have to then discuss if it's from a South African source. A South African source, if you go and look in section 9, tells you that interest from South African source, if it's paid by an SA resident, or the funds on which it is paid. So remember, interest is paid in respect of something. So you have a loan or a deposit or something which causes there to be interest. If that amount of money was used in South Africa, then it's a South African source. So either one of these. Now in this case, they tell you it's a money market account in South Africa, so it's paid by South African residents. So it is from a South African source. So that would mean that Alex, the non-resident, would be taxed on it. Okay, now let's talk about this. 1 March 2018 to 28 February 2019. And over here is 15 November 2018. This is 260 days. And the rest is obviously the balance. 105 days. On 15 November, Gareth, who is the donor, died. So what is important for you to understand is, during this period of time, Section 7 would apply, and during this time, Section 7 cannot apply. Section 7 only applies to this donation and the donor is alive. Now, if we go back to the information, if we look at what happens to that income, that 84,000, the amount which is paid to Alex Ringman is subject to Section 7.8, because she's a non-resident, and the amount retained in trust is subject to Section 7.5. So if I take that, the one to Alex, and I say 37,800 times 206 over, sorry, what's it, 260, sorry, not 206, 260 over 365. So 26,926, and the amount retained in the trust, which is at 46,200 times 260 over 365. $32,910. Those amounts under Section 7.8 and under Section 7.5, Gareth will be taxed on that, because that is during this period of time. He will be taxed on those amounts. It will be included in his gross income, and he'll be taxed on it. Gareth is a South African resident, so he would qualify, or a natural person, so he would qualify for the Section 10(1)(I) interest exemption. Right. And he is 65 or older. So he would get the amount which is applicable. So refer to your Psycho Student Handbook or the latest rates. So these amounts will be included in Gareth's income, and the interest exemption will apply to him. After he passes away, for 105 days, right, of the year, he was not alive. Actually, let's just go back. Okay, so for 105 days, so 37,800 times 105 over 365, and 46,500. Okay. So 10,874, 13,290. Alex will be taxed on that under Section 25B, Alex, and the trust will be taxed on the remaining portion under Section 25B. So we'll go into their gross income. Alex is a non-resident, so Alex can get the Section 10(1)(H) interest exemption, Remember that applies to non-residents receiving interest from South African source because she was not in South Africa for more than 183 days. And the trust, section 10(1)(I), can they get that? No, they can't, because that's only for natural persons. So the trust will be taxed on the full amount. So if I had to draw it up like this, Gareth, Alex, and the trust for the period 1 March to 15 November, and for the period 16 November to 28 Feb. So those amounts, Alex will be taxed on 10,784. These are, or 10,874, sorry, 10,874. And sorry, the trust will be taxed on 13,290. Section 10(1)(I). Section 10(1)(H) would apply to Alex. That full amount will be exempt. The trust will get nothing. And for the period before that, so that was that amounts times 260 over 365. Okay, what those amounts were. $26.96. And 32.19. Gareth will be taxed on that, and he'll qualify for the section 10(1)(I) interest exemption on that. So guys, very simple if you know the rules, but I just want you to see. So we discuss VAT. This is in the solution. We discuss income tax and withholding tax. Okay, please make sure that you see also, that's when they talk here about, they do these calculations. That's for the period, the 260 is when Gareth was alive. And once he passes away, after Gareth passes away, he's no longer alive, section 7 doesn't apply. So that's basically all it discusses there. So, very standard, but make sure that you make sure to discuss income tax and VAT as well for the easy marks there. Okay.